Welcome to our session on the future of investor reporting. My name is Michael Jantzi. I am a member of the International Sustainability Standards Board. So I guess obviously as a member of the ISSB, reporting and disclosure is something I spend a lot of time thinking about. But that is really about disclosure from the corporate side. And that's not what we're going to be talking about today. So for the next hour and a quarter or so, we're going to be focusing on reporting in regards to investment managers and asset owners. And we're going to talk about some of the reporting obligations that investment organizations have. You know, those reporting obligations cross different audiences, cross different jurisdictions. And it's not a new conversation to PRI. Maybe some of you have been in some previous sessions at other conferences where we've focused on this topic of investor reporting. But in those conversations, we tended to focus more on the challenges that investment firms face in reporting. And while we will touch on some of those things, we're going to try to focus on some of the solutions and focus on some of the ways that asset owners and asset managers have looked to address some of those challenges. And hopefully there'll be some things that you can take back with you when you return to your day job. So very happy to be here. Obviously, PRI is part of the reporting landscape for investment firms with the reporting framework. That being said, we're not going to talk about the PRI reporting framework today. If you're interested in learning more about that, I suggest that you visit the PRI booth. There's individuals there that can talk to you more about that, but we're going to focus on some other initiatives here. And to help us do that, we've got a great panel. And I'm not going to go deeply into their bios, but Laetitia is here. Laetitia is the head of sustainability advocacy and assurance at HSBC Asset Management. She's based in France, but obviously looking forward to your perspectives as an investment manager, but she also sits as a trustee on a pension plan, so getting that perspective as well. Leilani, thank you for being here. Leilani is with a superannuation or a pension plan in Australia, REST, so she'll talk a little bit about that. Really looking forward to your perspectives as an asset owner and the reporting obligations that you have, I guess focusing on Australia, so thank you for being here. And then we've got two individuals, Nadia, who's with Bloomberg, Lorenzo, who's with Clarity AI, to talk about how the ecosystem of those organizations that are reporting or supporting asset owners and investment managers, some of the ways that you're doing that, some of the things that you're seeing in the market. So hopefully we'll provide you some food for thought, and then we want this to be an interactive panel. Obviously, and so there'll be lots of time for questions and so on. Those questions, as I'm sure you're used to now, come in two forms. You can use Slido. They're open text questions, so it's not like a polling. So try to give you some ample time to put in, type in your responses to the questions, and then they come up as sort of a word cloud. So that'll be interesting, I hope, to inform some of our comments today. And then it's the old-fashioned way. Please raise your hand, get my attention in some ways. That light has started to burn my retinas, so if I don't see your hand, jump up and down, shout, whatever way you want to get the attention, and we'll get a microphone over to you. So first of all, I'm going to turn to you, Lorenzo and Nadia. Can you just help us put into context what you're seeing in this vast global space in regards to the reporting obligations for asset owners and investment managers, and just help us set the foundation, the stage here today.
Thanks, Michael, and hi, everyone. Look, I think I'll take my own personal experience to write that. I was, in 2009, I was one of the early members of the PRI, and I think at that time, really, the PRI reporting framework was the only game in town. It was the reporting framework for institutional investors, and there were around 200 investors, so the limited number of players actually running that. It was voluntary, so the type of element was voluntary. It was actually focusing primarily at the organizational level. It was looking at processes and policies, and it was focusing primarily on stakeholders as the kind of stakeholders and asset owners in terms of who the readers of that. If you fast forward to today, that has changed a lot. First of all, you have it a lot of mandatory. There's a plethora of reporting requirements out there. There's the alphabet soup. You can add it, and they're not necessarily speaking to each other. So that jurisdictional challenge of lack or limited interoperability is a key element. It's as I said, it's mandatory. It's now covering not only elements of policies, but it's looking at the impacts. Think in Europe, PAIs or PIs, that's what they're looking at. They're no longer looking only at the institutional space. They're trying to actually communicate to the ultimate consumers through a number of fund level requirements. And ultimately, the number of people playing is not the 200 players that we're reporting to PRI framework. The vast majority of the institutional finance space today is trying to report on these. Just think about in Europe, Article 8 and Article 9 funds represent around 60% of funds in the market. So, you know, there's an element of that. I think what the industry, where is this taken the industry is really on two main things. So one is that there's still a disjunct element between decision useful information and reporting, and those two things are not necessarily speaking to each other. So there's a big element still about compliance. And then the second piece is around the complexity of reporting that I think is forcing an harmonization on reporting. So you kind of have one type of reporting for asset owners, investment managers, for retail clients. It's kind of one blanket statement. And the second problem is that multiple jurisdiction reporting. So how do you actually report on one fund across 5 different jurisdictions? And that's complex, and that's what we're finding.
Great. Well, lots to food for thought there, lots to chew on. But one takeaway is a tremendous amount of change in a very short period of time and the proliferation of these reporting obligations. So we'll touch on that, no doubt. Nadia, your thoughts.
My takes.
Your takes.
Well, and thank you very, very much for inviting me to contribute to this panel this morning. And thank you all for attending. Hopefully the caffeine has hit the blood supply, because I am going to ask you to engage with me a little bit in some of these metrics. So I was thinking, what data am I actually seeing today? And I completely agree with Lorenzo in terms of we are seeing a growth in disclosure, but I think that is still very, very early in the start of compliance with mandatory reporting obligations. So one of the things I did was I just looked at about 2,500 financial companies globally, and I was trying to look at the data of what can I see that they report right now. So this is not necessarily focused solely on Canada. And the interesting data points, at least from my perspective, was about 2/3 of them have a climate policy. Great. I mean, you can see the success, for example, in frameworks like TCFD there. Now, globally, only 9% of those have executive compensation linked in any way to what they've committed to do within that climate policy. What is also really interesting is only half report Scope 1 and 2 emissions. So they have a climate policy, it's not tied to anything, they don't report emissions. And then about 1/3 have some kind of target, like a net zero target that they're adhering to. So I can see the journey that global financial organizations are on in the commitment. But then, because we have the pleasure of being in Toronto, I tried to drill a little bit more into Canada. So my ask to the audience and to show your hands, do we think that Canadian financial organizations are performing better than the global average? So if your answer is yes, just show your hand. If it's not, oh, that's interesting. Maybe it's just caffeine not hitting the blood supply. I would make that about 50%, think that Canadian financial organizations are doing better. Canadian financial organizations are doing significantly better than the global average. So I can see that about just shy of 90% have some kind of climate policy, and 22% of that 90% have tied that to executive compensation. That is impressive. I see much higher reporting of emissions, and I see 50% of the whole community making commitments towards net zero targets. So actually, there are global differences. And the thing that I found particularly interesting for Canadian financial institutions is there's still a very light touch regime in terms of what's expected to report. If I compare those data points, for example, to Europe or to UK, where there's some tighter mandatory reporting, I see very different numbers. But I think the growth of that is super impressive when you start to drill into the data. And if I may, just one more point.
Yep.
I was then just drilling a little bit more into what does that climate policy actually do. And so from a climate risk perspective, and again, I'll only focus on financials in Canada with these data points. So remember, I'm saying just around 90% of them have a climate policy. 67% are discussing climate risk. I thought that was quite an interesting thing. 47% have identified material physical risk within that assessment. But actually only 35% have used robust climate scenario analysis in a way that we could determine that they meet at least our data collection needs. And only 16% have a transition plan talking about how they can commit to net zero targets. So I still think there's room for growth within that disclosure.
So we're in early days. There's been a lot of change evolving, but it's important to have data to provide, you know, some realistic views in regards to direction of travel and so on. So thanks for that setting, and thanks for getting the interaction going. We're going to leverage technology a little bit. We've got just a couple of polls that we're going to run through the session today. The first one, and these are open text, there's no voting, so we'll give you some time to type in your answers. So the first one is just, we want to get a sense from you, in your work situations and your reporting obligations, what are some of the challenges that you're seeing and some of the trends or changes in this regard in your experience over the last several years? So as I said, the answers will come up on the screen as you type in, and we'll just get sort of what I call a word cloud. I don't know for you tech folks what the proper terminology is, but we'll get a sense of what people are thinking. So lots of themes there. Overwhelming is one that I hear a lot about in my day job. Good. Well, I'm not going to comment on those, but I think, you know, you can see some of those themes emerging, and maybe those are some things that you'll have the opportunity to tap into in your comments. And so I'm going to shift to you, Laetitia, if I may. So again, bringing the perspective you have as an investment manager and an asset owner, can you talk about, I mean, as an asset manager, obviously HSBC is working through a number of different jurisdictions around the world, and you have a number of reporting obligations. Can you talk a little bit about, again, the challenges that present to you as a manager, but then also share with the audience a little bit about how you've looked to address those challenges and some of the initiatives you've put in place, the innovations and those types of things?
Yeah, sure. Yes, actually, Lorenzo and Nadia already touched upon what I would kind of say the dynamism around regulatory reporting requirements. And because everything came in a very short period of time, you know, we had a big asset manager such as HSBC with a global footprint, really had to adjust to many different requirements. And, you know, so with regulation, which are quite similar, but not exactly the same. But, you know, just a small change in a definition does have real impact in your infrastructure, in how you implement those regulations. So the first challenging thing is to really understand the regulation, to make sure that you get the purpose of it. That will be really kind of the first discussion that you need to have with your risk, legal, and compliance, and of course, with your subject matter expert in sustainability. And then, of course, there's a lot of challenges around implementation because you need to understand the data that you are collecting. And you need to collect the data. You need to have, you know, cleaning around the data. You need to record them. So there's a lot of, you know, really a lot of technical issues around data. And then you do produce content. And this content, you know, it's not always a one-size-fits-all. So how do you ensure that the content you produce for one market will also be relevant for another market? And so, yes, HSBC asset manager, which has local product, but also which has cross-border products. This is really part of the challenge that we as other asset managers that we have to deal with. On the other hand, we know that we know about the value around disclosure. I think you're all familiar with different theory of change around disclosure requirement. And this is definitively something that we have seen, for instance, in the French market. First we had reporting requirement around climate and biodiversity. And because of those requirements, then asset managers, the whole ecosystem had to be more creative, to talk to each other, to review the investment process. And so we did see a lot of new products being released in the French market. So we do see value in those reporting requirements. But now, how do we do as a big organization? It's really about change management projects. And I think, so for sustainability, it's not about starting from scratch, reinventing the wheel. As an asset manager, we are producing reporting like forever, actually. We have reporting requirement also forever. So it's rather, how do we integrate sustainability inside those reporting, rather than just starting from scratch and thinking a whole new organization to address those new requirements. So we do have different, we have first line, and then we have risk legal compliance, which is going to approve the content. So each time there's a new regulatory requirement, first, as I said, we need to understand the requirement. And then it's really about putting in place a team which will help put in place this change. So it's really about being agile enough to implement those different changes in a timely manner, while ensuring that you have a robust governance to maintain, the high quality of risk and control that you need to have around those processes.
So I just want to pick up on a couple of things you said, because again, these are obligations that you have, and you said HSBC is not new to reporting. But I think sometimes in sustainability, at least historically, organizations had the financial reporting, for example, and sustainability reporting as silos. And you've said that it takes, there's a lot of different teams that have to be involved in coming together. I'm wondering if then some of these reporting obligations have forced an integration internally, in a sense, and if there's opportunities through those innovations. And you also mentioned change management, the extent to which you at HSBC have really had to formally project management these changes. So you need to put the time and human resources and really consider these serious change management initiatives to be able to address some of these things and some of the opportunities that have come out of that.
Yeah. No, so definitively, actually, but this is really the choice that HSBC has made, is to have some dedicated team to sustainability, so really what I call the subject matter expert. But then really the purpose is to integrate sustainability within the process. For the clients, of course, which want sustainability. And so we have put in place a governance which enable this to take place. Mm-hmm. And for instance, with regard to the risk framework, we haven't developed a parallel risk framework. Understanding risk is really key for any financial institution. So we have taken our existing risk framework, and we have looked within this framework where sustainability should be integrated. So it's really an ongoing conversation with the people from the sustainability team and all the other part of the business. So we have in place integrated committees where this conversation takes place, and we had to make sure that this all goes to the higher level within HSBC, so really to MEMCO, to global CEO, global CIO, global legal. So it's really key to the way we implement those different regulations. Yeah. All
right, thank you. We're going to come back to another point, but Leilani, I want to go to you from a sort of an asset owner perspective, again, in Australia. You're with REST, so I'm not sure if REST is as familiar to the audience, so please, can you just talk a little bit about what it is you do, and a little bit, I know you've been around since 1988, and you have about 2 million members, as I think, and just talk a little bit about the reporting obligations that you have and some of the challenges associated with that.
Thank you. So I guess I'll start by introducing REST. We're a 57 billion US superannuation fund, otherwise known as pensions in other parts of the world. Our 2 million members are across the age spectrum, but really interesting is that 50% of our members, so these are our beneficiaries that entrust us with their retirement savings, are under 30. So if you think of a 24-year-old today and then think when they retire in about 2067 or 2070, it's quite phenomenal to think what the world will look like at that point in time. So taking a very long-term investment horizon for those members. What's been really energetic in Australia is our mandatory climate reporting regime that's just recently come in. And that regime has had 3 real layers. The first one was setting the legislation. The second one was getting the standards, and that was very much adopted from the ISSB. And then the third is the assurance standard. And so we've been going through this process as part of our broader Australian sustainable finance strategy for around the last 2 years. And one of the really big changes for us as an asset owner is we will now need to have a very formal sustainability report that gets lodged with our financial statements, and our directors will need to oversight this report and be very comfortable that it meets the standard. And that's a big game changer for our team as an asset owner.
Yeah, whenever you're talking about the obligations of the senior levels and the senior governance levels of an organization, it changes the conversation a little bit. So what are some of the things that you're looking at within the organization internally as far as processes and things to address some of the, well, new reporting obligations, some of the challenges you're seeing?
So I think one of the benefits for REST has been that we started voluntary reporting a number of years ago. That has been helpful, but it has largely been the responsible investment and sustainability teams coming together. Over the last 2 years, the very energetic period I talked about, what has started to happen is we've now got our risk teams involved. We've got our regulatory relations, our policy teams, our finance teams. And actually one of the projects that we did, we initially started a project just to enhance our sustainability strategy. And when this reporting regime came in, we actually pivoted to focus just more on the mandatory climate reporting. And then that resulted in our CFO taking sponsorship of the reporting, as well as our CIO on the implementation. So it was a process of upskilling to get to the senior sponsorship that we need.
So we sometimes, when we, in business and organizations, and we make changes, we try to identify what the challenges are going to be and set policies in place to address them, but there's often unintended consequences. I'm going to flip that around. Have there been unintended opportunities at REST that you've seen from the structural changes you've made, the procedural operational changes you've made because of these reporting obligations that have been placed upon you?
That is a great question because
I'm
an eternal optimist. So I think one of the things that I've really seen change is in the world of investment data, there has been a real trend of this is our investment data, this is our ESG and climate data, and sometimes it's very hard to integrate the two worlds. Mm-hmm. What we've started to do through this process is we've launched a significant data transformation project with data architects, data specialists, all backing us in the integration of this data. And it's been huge. And the learning, when we started this project, the head of transformation and I, she said, where do we find these people? And we were like, we're just going to have to train them. And we did. And so I've now seen people in our organisations that 18 months ago wouldn't have been able to talk to you about greenhouse gas emissions, what scope 1, 2 and 3 are, what PCAF is, and they're now all more expert than I am. So it's been great to see.
Okay, that's great news. I mean, to see those changes happen in an organization. Can you talk a little bit about the external environment a little bit? You've talked about 2 million plan members and sort of the demographics of that. Can you talk about how you know, there may be changes in how the opportunities to communicate with your plan members have changed. And maybe as part of that, one interesting thing, at least to me, about Australian pension plans and supers is, which is a little bit different than many jurisdictions, you actually compete for members with one another. And I'm just wondering, is there a competitive differentiation aspect here? Is that part of the equation? Just help us understand the external opportunities you have as a fund.
I think the opportunity we have is that we have multiple audiences for this reporting, but also we've got all the implementation work that will help us be better investment people. So I think on the external point, the fact that we can have a sustainability supplement climate reporting, that we need to make sure that our members understand that and that it is member friendly as well as regulator and other stakeholder friendly. So I think our attention now is turning on to how do we report in a way that actually just the average person on the street would find interesting and compelling.
Right. So Laetitia talked about the fact that HSBC needs to report to different jurisdictions, and they try to scale that to the extent possible and take, what I heard anyway, was to take some of the content or as much as the content from one and leverage it for another. Are you able to do that? Because obviously there's a regulatory obligation here that you're reporting to a regulator. You've just said you want to talk to multiple audiences. To what extent in your organization are you able to sort of have that central bank of data and then tailor it? Like how big an effort is that for you?
It's significant. So
Okay.
in investments, we often talk about an accounting book of record and an investments book of record. And for us, this is all about ESG data being in that investments book of record, and then multiple users across the organisation can use it for their various use cases. That's where we're aiming for.
Okay. Great. Well, thank you for that. I'm going to come back to you on a couple of things a little bit later on, but Laetitia, I want to come back to you because one of the obvious things that I think a lot of investment managers and so on are dealing with is the fund labeling, the product labeling, disclosure regs, and I know you're in the middle of that. So can you talk a little bit, just briefly, about those challenges and how you're managing those if they're unique to what you talked about earlier?
Yeah. Well, actually, the first challenge around this, around labeling, is that the work is not finalized yet. So it's still, you know, for instance, in Europe, we do have the ESMA guidelines, but we don't know yet which European country will implement those guidelines. They have until October 21st, if I remember well, to make, I mean, each country will make a decision whether they adopt the guidelines, yes or no. So we may end up having some, let's say France, which adopt the guidelines, and another country which say no, and another, so we'll see, really see. So we need to see how it's, where we land on this one. But in any case, I mean, it's mandatory, so we'll have to meet these regulatory requirements. And so here again, it's really back to my first point. It's really a change management program, so really understanding those requests and being able to implement it. And actually, I think the part of the challenge then with those labeling, it's not only for us to implement, but then for our clients to understand what is behind those different names. And so I think that then it really depends to who you are selling your product to. I mean, if you have this conversation with asset owner, most of them, they have internal expertise. And otherwise, I mean, you can have one-to-one discussion with them, so you can really explain them, you know, really the content of the product. You can really go into a deep conversation with your asset owner. But then for the products that you sell to the retail, so you go to distributors. So we do have, of course, process to have, you know, to have discussion with our distributor, due diligence, and a lot of questionnaire, things like that. But I think for me, it would be not realistic to imagine that the retail, you know, like the individual savers, will really understand what is behind all those, you know, naming. So then the question is, because the idea around fund naming and labeling is to bring trust, is to reduce risk of greenwashing, is for people to be confident that when they put their money somewhere, it's really where they want it to be. So here, I think for the retail sector, we will collectively need to be more creative. I think it's going to be a mix of, some organizations such as PRI or other associations. We probably have to do some translation, some training, some awareness. We can also, in France, for instance, we have a French chief, the so-called FIR, a Responsible Investment Association, which has a dedicated commission really focusing on communication to the retail industry, and which is trying to, to do some awareness around responsible investment. And believe me, that's quite a difficult job. So I think for the retail, it's going to be more difficult for them to really understand what is behind all those different products. And maybe part of the solution will be kind of really standardized responsible investment label. And for instance, when you buy food, when you buy biologique, bio food.
Organic food?
Organic food,
Yeah.
yes, thank you. When you buy organic food, you don't have all the detail of the process, of what is behind, but you just trust the label. So maybe this is something, a similar approach that we need to have for some of responsible investment label for the retail sector. Just ask them to trust the label, and yeah.
So, again, a possible solution is we're going to need collective action. And some of that, as you said, maybe at the regional or jurisdictional level, but then the macro level. And if people are listening from PRI, you suggested, as a good PRI board member does, that there's a role for the PRI in again, supporting the membership and bringing value to the membership. So thank you for that. So I am going to shift to solutions now because I want to make sure we've got time for questions and answers and that active participation with the audience. But before we do that, I'm going to go back to you, Lorenzo and Nadia. Again, you work with asset owners and investment managers. You know what's happening in the ecosystem. We've heard some of the challenges. You live those challenges, and I know you're trying to support, and the industry broadly is trying to support, fill gaps and so on. Lorenzo, I'll start with you. Can you talk about some of the things that your tools, things that you're seeing out there that can help investors through this maze?
Yeah, and look, I think maybe a good way, and it was interesting to hear the investors here. I think what I believe an investor will be doing to get to a report is, the reporting is the end of an investment decision-making process, right? And so there's, at the bottom, you need the data. You need to convert that data into insights. You take the investment decisions and then you report, right? So at each stages of this, supporting the institutional investors with solutions in the market is something that I think is critical if we want to achieve the goals that we're setting forth. And by the way, one of the things we also explore, and I think it's interesting to see, is how the market is actually leveraged on technology and AI to achieve this. And I think what we find is that by doing that, you kind of address what I'm hearing are two kind of important points that I was mentioning earlier. One is the challenge of how do you make sure that the information that's being collected for reporting is actually decision useful? And so how do you make that happen? And then the second thing is how do you make sure that the complexity of reporting still allows for a diversification of communication? I think both of you mentioned the importance of tailoring the communication a specific group. You know, what an asset owner versus a retail investor might have a different need. And so in that, the really first piece is getting the data right. Because if you want to get the data, if you need to get the data to be able to ensure that the decision and the reporting are accurate. And this is where technology is particularly helpful. AI is now able to actually jump in and enhance the coverage, the quality of data, or where metrics are not there, convert into, modeled data. And the modeled data can be tagged for the level of confidence that you have, which enables an investor to make a choice if to use that data or not. And also the transformational element of what now is a greater of access to unstructured data, like satellite data that can be used then into investment decisions. So getting the data right is the first thing. Then the second piece is looking at, okay, how do you convert this into knowledge, insights? And I think, again, that's where the ability of technology today is to look at this vast amount of data that it's kind of funny, you have the too little, too much data paradox here. And the too little is let's get the data in. The too much is now this information is how do you process it to get useful information. And that's where, these the ability to manage large data into some interesting insights is where AI comes in, both from a backward-looking and a forward-looking side. So that's where trying to get what is a good transition plan through AI and where is quality transition plans is something that the industry, you'll see a lot of players are trying to get there. But then the third thing, which is I really think the focus is, okay, you made the investment decision, now you need to report against it. And where technology can help is simplify that so that instead of spending a lot of time on compliance, you're actually shifting on the investment decision. I'll give you an example. Now there's solutions in the market where you can, for SFDR, you have to produce these recurring Article 8 reports, right?
Yep.
So now you can go and get solutions in market where you know what the sustainability data is because it's part of what you have with your provider. Then you have a recurring report that already exists or a pre-contractual report that already exists. With answering a mini survey of 2 or 3 questions, AI is able to collect all of it and produce your next report. And so that reduces for some investors 80% of their workload. So that frees that time. So that's the first thing. And then the other thing is really the importance of tailoring and using solutions that do that tailoring of the information. So for example, some consumers might just want to know their decarbonization based on the amount of flights between London and New York versus what is their pi score, or what is their pi data point. So that sort of tailoring, I think, is quite useful. And the very last thing, and then I'll stop, is there's this element around, okay, and Laetitia is mentioning this, if you want to set a fund and you're a global player, which fund is going to enable, what design is going to enable you to actually be a sustainable fund in different jurisdictions. In the US, in terms of the new categorization rule, or in Europe in terms of SFDR, or in the SDR that's coming up in the UK. And so being able to do that early doesn't force you to then need to rethink of all your fund naming and your fund composition later. And that's where these solutions can start to help.
Okay, so technology is not only from a sustainability perspective, an integral part or an increasingly important part of the investment decision-making process. It can actually then help on reporting out to different stakeholders. So thank you for that. Nadia, same question.
Same question.
Yeah.
Lorenzo's done such a good job with answering it. So I guess maybe 3 things that I'll try and cover off. The first is starting back to basics. What do I see in the world today? The second is maybe touching a little on the flavors and shapes of data that are demanded from us. And then the third is kind of places that I think we in the data vendor community need to continue to invest to service the need. And some of that kind of popped up in the Slido questionnaire for this group. So if I start with the kind of back to basics, and maybe Michael pay tribute to you and ISSB. Previous to that, what was the world that we were seeing as data vendors? So we were seeing a collection of E, S, and G data points produced differently across the globe, differently within and across sectors. And by differently, what do I actually mean? Different metrics. The report name varied year on year. The report location varied year on year. The alignment between what was reported in the financial statement of the firm was almost non-existent, and or you would see significant delay in when that report was produced. So unlike having a fiscal reporting period where you can expect the financial accounts, from an ESG perspective, it comes in up to 15 types of disclosure, and the periodicity isn't consistent. I do not know the date on which I will receive ESG data from a named company. So that's the landscape we operate in. From a data vendor's perspective, the job we have in producing data for you is normalizing that data. It is clear, it is comparable. If I am looking at a Vietnamese dairy or I am looking at Google, I can see and understand certain E, S, and G metrics as if they were comparable between those 2 organizations. That is our job. Now, I fully recognize that globally, we're having ISSB step into the remit. We have a number of jurisdictions looking to adopt a standardized way of reporting. And I think that is a phenomenal improvement. And so therefore, when I think about the next evolution of the role of a data vendor, if we get globally consistent and comparable data, which is the utopia for sure, what flavors am I seeing? So point number 2. The flavors that I'm seeing that people are asking for is, number 1, how do I build better portfolios? So definitely to calibrate an objective relative to whatever that objective may be. There is no singular definition of sustainability. The second, exclusions. I want to remove things that I consider harmful or that my asset owner considers as harmful. And the third is obviously good governance. I want this basic standard of good governance, however I choose to define that. So I need a suite of data that allows me ultimately to build better products. The second flavor I see is risk. At the moment, the narrative is very climate-related risk, nature-related risk. But I would say for the community right now, we are in a place of risk identification and quantification, and not necessarily in the evolution of risk management. So we're still getting the how do I quantify, how do I normalize, how do I understand this? And then we'll definitely, as a financial community, move into what I hope will be a very innovative space in risk management. And then the third one is regulation that all panelists have spoken to today. And regulation is taking very specific data points for the purpose of disclosing to various regimes. And so those are kind of the 3 flavors. And then when I touch on my third point, which is, where are we being asked to continue to innovate? It's actually in joining data sets together. So when I start to think about, we have financial metrics that you touched upon. So if I have financial metrics like the segmented revenue or the segmented capital expenditure of a company, can I identify green or environmental characteristics within either the revenue that's being made or the investment that the company's doing? Can I also knit that together with supply chain data? There's a lot of ask on supply chain due diligence, things like deforestation-related regulations, certain due diligences that are now expected of the investor community and or the corporate community in understanding their value chain. And I'm also starting to see asset location being really important. And then an overlay of geospatial. So that would be in the shape of physical risk, that would be in the shape of kind of impact on ecosystem health. Those are the overlays. So actually what we're now trying to see as the evolution of data is not just the collection and making available, but knitting that together with supply chain, knitting that together with geospatial and locational data sets, and trying to paint a picture for an investor that truly helps them see and understand either an objective they want to pursue or a risk they want to manage, or a regulation that they want to comply with. So that would be kind of the flavor that I see today.
Okay. So I'll invite you to put your questions in through Slido. And again, the old-fashioned way, that works just as well for me. If you want to raise your hand or get my attention, we'll get your question. We've got a couple of questions coming in. And it's interesting because we've had the discussion has touched on both information needs that investors have to make decisions. We've talked about that, but also the information that asset owners and investment managers also need to then report out to a variety of different audiences. And we've talked about the challenges of having to operate in a global environment when reporting is sometimes inherently regional or jurisdictional. And even within those jurisdictions, there's different audiences. So one of the questions we have here gets to that first tension. So we've talked about decision useful information that you and your investment teams need to make informed decisions. And we've talked about client reporting. And let's use client as in a broad sense. Client being a regulator, client being a plan member, a retail or institutional client. How do you reconcile the two? Because there may be a tension between those two. In other words, what your investment teams need versus what you have to report on through a regulatory or increasingly regulatory obligation. Do you see tensions between those things? And if so, how do you reconcile or deal with those tensions? And Leilani, nobody said you have to answer first, but I'm going to you first.
So I don't know if I'd call it a tension. I'd just say that it's probably data being used for different purposes. But the one thing that I am a bit of a broken record internally by saying 80% of this is implementation and 20% is actually reporting. So that's my motto, because I really, and I'm worried about, I see it now investment managers too, that we cannot be pulling resources away from those implementing sustainability to just do reporting because we need something to report. So I think the bigger tension is there rather than the requirements. Like, even if I think of the 100 or so requirements that is in our sustainability reporting standard, the requirements are actually quite sensible. Governance, risk management strategy, metrics and targets, these are all good elements for sophisticated organisations. And I think in terms of, if I look at the purest of greenhouse gas emissions in scope 1, 2 and 3, we have a net zero by 2050 target for our investment portfolio. That data is decision useful every year. So I think, and the scenario analysis requirement, that's another exceptionally decision useful tool that we have as investors. So I think it's more about the doing for the purpose of investing, and then the doing for how do we actually translate that to the non-investors.
Just to follow up, and then Laetitia, I want to come to you on this too. Do the reporting, the information that is you're being asked to report on by an outside party, has that influenced the focus of the data you're looking at on the investment side? So in other words, is there, you call it pressure, you can call it an opportunity, somebody else's, but has it changed the focus at all internally?
So in looking at this positively, Australia has taken a climate-first approach to our Australian Sustainable Finance Strategy, but it's not a climate-only approach. So REST at our sustainability strategy has 5 sustainable development goals that we are always looking to align to. And so whilst climate, which is really 2 of those goals, affordable and clean energy and climate action, whilst they're taking priority at the moment, we know that gender, reduced inequality, decent work and economic growth is coming. So it's helping, I guess, prioritise getting the foundations set up through climate so we can do more through the other ESG factors.
Okay, great, thank you. Laetitia, any comments on tension?
Yeah, actually, I also don't really see tensions between, our investment, our own internal requirements, and then the reporting to clients, to clients. I think that, when HSBC Asset Management put together a policy, be it a coal policy, fossil fuel policy, any kind of policy, the team did a review of regulatory requirements, and so actually it's part of the policy, and this policy will be mandatory for all local entities, provided that, of course, it does not go against a local, specific local situation. And so actually this policy is already, I would say, a mix of identification of what we think our clients' expectations are on regulatory requirements. And so this is why I don't really see tensions around, the different things that we would want to implement. Maybe if an asset manager receives a specific reporting requirement from a client, then of course you will have questions around capacity to deliver, because of course you have limited resources. I think it's part of the discussion that you have with your clients. And just to give you an example, so here I'm going to take my FRR hat, so FRR being a French asset owner. And as you mentioned, so I am a member of FRR Supervisory Board. And actually, FRR has no, reporting requirements. This fund does not have to comply with the reporting requirements, which are for the other French investors for different reasons. But in any way, they decided to produce a report. So FRR, all the assets are invested externally, so with different external asset manager, and they make a public request for a proposal to identify a service provider which is going to collect all the portfolio from the different asset managers in order to produce a dedicated report to help them understand how their responsible investment approach is being implemented by the different asset managers. That way, it helps them understand, like have a vision on climate, biodiversity, the understanding their impact, setting targets. So their approach has been to hire a separate service provider to do this job for us, for them. And actually, because they really see value in this reporting, then the next step, this is something they are doing this year, they want to use this reporting as also a way to support, to help decision making, to review the strategy, or to review some orientation, and to not have a clash, I would say, between ranking and advisor activity. So this year they are releasing, they have launched a public request for proposal to identify one service provider which is gathering the data from asset manager, and then another service provider which is going to make this analysis. So just to give you an example of, let's say, for these funds are first reporting as values, and then if we were to have different requirements from an asset owner reporting requirement, then there is capacity to do it another way, for them to have the information they need without putting all, I would say, the pressure on asset manager.
Okay.
Yeah.
Thank you. Nadia, please.
Yeah, no, can and maybe to kind of broaden my introduction a little, because I want to represent maybe a little bit on the view of the policy side here in terms of what's being asked for. So I am very fortunate in that I have Bloomberg C at the European Commission, working directly with the platform. I also sit in an advisory capacity to ESMA. I work on the Australian tech. So when we do advise policymakers, kind of the way we think about disclosure is very similar to kind of these standard set of metrics. And my anecdote here is the same as if you go into a health food store, you may have a very different definition of health. You may say, Nadia, I care passionately about organic ingredients, right? And so you want to see the proportion of organic ingredients that are in a snack bar that you want to purchase. I may care passionately about low carbohydrate as my definition of health. So I want to be able to see a carbohydrate metric. Now, we're not mandating that every single health food bar puts organic ingredients on its list or carbohydrates. We do, right? So then there's a disconnect. So we've got these common standard metrics. If you think about nutrition, fat, carbohydrate, protein. But then we have this overlay of what qualification of healthy that producer says they have, and then explaining that metric in some meaningful way. Now, I definitely think there is a friction in that at the moment, only those products considered to be sustainable have an obligation to report. If you compare that again to food, I can buy a chocolate bar with no real health ambitions, but it still needs to baseline report to me those nutritional ingredients so that I can make a comparable decision about what I choose to snack on. And I think what is really critically important when we're thinking about it from a policy lens is there is a common baseline ingredients list that really should be disclosed, frankly, on everything. And it should be minimal. And then there is the opportunity for an investor to have creative freedom in defining sustainability and explaining how they've defined sustainability, in explaining the KPI or multiple KPIs they are measuring, and allowing that to be attractive either to retail investors, to asset owners. And I think one of the concerns that I definitely see is definitely a push towards, sustainability defined as a single number or single metric, and or the stifling of creativity and or the massaging of products to try and look good on a singular set of metrics. So I think balancing that friction is an important part as we move forward with policy.
All right, thank you. Just picking up on that, and I am going to go to the audience to mix this up a little bit. So that's not exactly fair to those of you who put in the Slido, but I don't care. So please, if you want to just stand up, and if you can just say who you are, where you're from, just to put your question into some context, and please.
Yeah, thank you. My name is Eric Bormans from Pictet Asset Management. Just a question to what has just been said. Leaving the freedom to every asset manager to define what they mean by sustainable investment. All right, how about leaving every asset manager the freedom to decide what they mean by investment grade or high yield? How would that fly today? So I'm sorry, I have a little bit of an issue with that. I agree we need to leave some flexibility, but we also need a common language. So how do we reconcile that?
So I think look, the place I agree with you on common language and the work that I've done in taxonomies is definitely to say, look, we need to define environmental sustainability in some meaningful way. But where I mean freedom on objective, you may have an objective with a policy that is related to water. You may have an objective that's related to circular economy. You may have an objective that's related to climate adaptation, climate mitigation, right? Those 4 products could be very different. They could be holding very different companies. They could be saying, my journey is I want to take high carbon companies and I want to reduce carbon in some way. They may be, I want to only invest in companies that are already low carbon. Now, if we go and say there is only one way of doing sustainability, then I get confused by that. I get confused by, are we expecting that a company needs to demonstrate all? And maybe we are, and maybe that is the end ambition. But definitely when we think about the creative freedom, there will be certain products that are attractive to investors, and there will be certain products that are not attractive to investors. But I think the opportunity, because data is so rich, to start to think about what you want that money to do over the long term is really important. And actually the level of sophistication, even of many retail consumers, is reasonably strong nowadays. And therefore, the opportunity to cater is important. I struggle with one number that says how sustainable product A is versus how sustainable product B is. Quite often, those things are methodologically different rather than even holding different companies.
All right. Sorry, I'm going to go back to this, but I'm coming back to you. I would, you know, in Canadian parliamentary tradition, by law, I'd have to give you a follow-up question, but I think we're going to move on because I've got lots here. I'm not sure that debate is over, but it's a really important one. There's a question here that, again, is maybe on the same theme of what is it that we're reporting, and we focused a lot on climate. We've talked about nature a little bit, but the question is, and I'll throw this open, what type of social reporting metrics are you reporting on? You know, and if you want to give us a sense of that, that, you know, beyond environment or beyond climate, and if so, maybe some sense of what they are.
So at the enterprise level, REST as an asset owner and a fund, we do report on our own social related metrics, like how we look after our people, what's happening in our supply chain with our key partners. But in our investment portfolio, we have a real focus on the social side, and probably more in the Australian context in our active ownership with First Nations and Indigenous rights. So whilst these may not be metrics, these, so we're getting away from numerical and more into qualitative. So what engagements have we been having with companies where these material issues, where we see there is significant value in a company improving these types of issues? Health and safety is another big aspect for us that we will focus on in our engagements. And also just fair labour and decent work will be always something that we look at too. But that transpires more in our active ownership than it does in a data portal that we could type in and say, right, how are we going on that?
And reporting out to your plan members, is that an expectation that they have? I mean, if you take that out through the Australian market, I mean, is this something that plan members of superannuation schemes will expect? Is this something, again, that is a little different for you, is unique or more unique to your experience? Can you give us a sense of that?
Yeah, I think every year we hold an annual members meeting, and interestingly, a lot of the questions are on ESG related topics. So, we'll give the investment update, we'll give the performance update, we'll talk about markets, and then, sometimes it's maybe, if I have a rough guesstimate, it's 60-40, 40 to perhaps ESG related questions. So there is interest from our member base. We survey our members. In the most recent survey, 86% of our members said that they would like to see us invest in energy transition and sustainability initiatives. So that's a pretty big flag to know that we're going in the right direction.
So reporting out is a catalyst for a good exchange of information, which then can inform your decision-making strategy, business models, and decisions. So that's an opportunity that comes out of this reporting matrix, in a sense.
And we don't expect our members to read our 60-page sustainability supplement from cover to cover, but what it does help is for all the teams we work with internally to pull the bits of information. If we've got financial advisor teams or engagement teams that are able to go and talk to members, that's a great reference point.
Excellent.
Thank you so much. Kirsten Spalding with Ceres. I haven't heard the panel talk much about transition plans and the need to disclose transition plans. Because the investors that I work with in North America are very much focused on the systemic risks to the portfolio around climate, but also water and biodiversity, they are really focused on how to disclose those risks, and TCFD, TNFD, and certainly ISSB's role has been critical. But it seems that the next horizon must be, what's your forward-looking plan? We're beginning to see disclosures of strategy, but not full-fledged investor climate action plans that would cover how the investor is going to address those risks that they've already identified. I'd love to hear from others about your experience.
That's great. And George Beasley, that I hope is going to answer your question on transition plans too. So thank you for that question.
Well, look, yes, we're hearing over and over is that being a critical part of what needs to be tackled now. It's the usual, let's not decarbonize our portfolio, let's decarbonize the real economy, and how do we get there? I think the challenge is, again, transition plans can go into hundreds of pages. So one of the things we looked at is how do we enable the investors to actually do this in a way that is achievable with the amount of information that need to process. And so we actually, one of the interesting things is we did a research piece recently which looked at the top 400 kind of most, basically the most impactful companies in terms of emissions, and we looked at those, and the vast majority do have transition targets, transition plan targets. But then we looked at if AI could help identify how much of these had measures to achieve those targets, and if those measures were quantifiably bringing you to that actual target. And what we found is 40% of those 400 did, and 60% did not. So in terms of trying to filter some sort of level of quality of transition plan, I do think that's something that's increasingly being asked.
Any other comments?
No, exactly the same. Quite a lot is, number one, is there the existence of a transition plan? The next is, how credible is that transition plan? And quite a lot of that is the combination of, financial metrics, the improvement in certain production metrics that demonstrate that they're on the right pathway, and/or the right governance around that. Is there leadership that is accountable for achieving those goals? So the data set you have around a transition plan is quite an interesting data set that we're starting to explore with as well.
All right.
I think in the Australian standards, the transition planning is one of the requirements. And so what's interesting is we've had a net zero climate plan, but as we're going through this transition phase into this mandatory reporting regime, we're actually taking stock before we release our next, because they used to be called climate action plans, they're now called climate transition plans, so we're just navigating that gap. And I think as a result of that, it does allow the organisation just to breathe, because it's been very rapid change in the last few years. And I think at some point you just have to take stock and think, what have we achieved? Where are we now heading? How have the requirements changed? And what does it mean to get there? So I think the next 3 years are really exciting in this space.
All right.
Yeah, and I can echo to that. I mean, both HSBC management has committed to NDAM, FRR has committed to Net Zero Asset Owner Alliance. So within those two organizations, I mean, there are strong commitment to net zero, but it is really worth acknowledging that there's a lot of work required to to produce those plans, and so this is under progress. Both of them. Yeah.
Great. Another question coming through Slido. What do you see as the cutting edge or best case examples of leadership using reporting mechanisms to manage risk or identify value available, and then reporting that out? Are there some best cases beyond your own corporate examples that you can point to?
I think
Who do you look to?
I think what we found some really interesting example in the private wealth space, because they have to communicate back to a specific kind of customer that actually wants to see the information, has time to see the information, but wants to see it in a communicatable way. So again, I think the really critical element, I think, is those that do it well has thought of who the end users of that report is and have tailored the design for that need. Okay. And I find that wealth management is doing this.
And do you believe that's scalable? I mean, because private...
I think it is with technology. I mean, we've seen that, and I think that's one of the things you can end up doing actually is within limits, and I think you need to be cautious or judicious in doing this, but you can start putting out to customers, clients, both asset owners and retail, the possibility to converse with your portfolio through kind of generative AI solutions. Now that's probably not fully there, but we're getting there. And I think that's an interesting way to try to do that.
Okay. Any other comments before we move?
I think what's interesting is, as an asset owner with many investment managers, we gain a lot of insights from what they are doing, and many of them are far ahead of us. But one of the things that has really resonated with me is one of our managers' ability to just using technology to fast read sustainability, company sustainability reports, show us where there's changes throughout the years, and very quickly put a set of questions together for an engagement with a company. I think that technology piece is just so critical, and I think asset owners are going to need it ourselves for all the reports our investment managers are going to give us. So just really using technology, I think, is something that we are going to have to do.
All right. I'll keep going with the questions here on my screen. So again, as an asset owner, asset managers reporting out to your clients, those are different obligations, but some of those obligations you're reporting out based on the makeup of your portfolios, right? The investment portfolios. And obviously then your investment decisions, when you're integrating sustainability data, you're doing across investment portfolios. So private data, or on the credit side, or private assets and so on, which I can't speak for HSBC or for REST, but those asset classes on private side in many places around the world are increasing in the allocation. What are some of the challenges you face in regards to getting the data you need from private companies, and then in turn reporting that out across those asset classes to your plan members or to regulators? And what are the expectations from your stakeholders in that regard?
Maybe I can answer to this question from FRR perspective, from the French asset owner. Because actually this asset owner has committed to invest in private equity, really to support the development of economy in France. So it is really part of the responsible investment approach to dedicate some fund to the private equity. But then really the challenge is how do you demonstrate that the outcome of your policies, also to still have the support of your internal stakeholders, because FRF, the different stakeholders is government, so unions, employees, governments. And so in order to be able to keep having this ambitious investment policy with regard to the private sector, it needs to be able to come back to the board and to demonstrate once again the outcome of those investments. So getting data for private equity is key, and actually, this is often what the feedback that they have, that the ESG team have, is that, well, difficult to have. It's not, they don't have all the data they need. Sometimes we can say, okay, we have a stronger place in the governance, so maybe if you don't have standardized data, you still have some qualitative discussion, which can help better understand, what's happening in the different companies. But yes, it is a challenge. But despite this, they keep, bringing some report, maybe not complete, but with the information they have. And actually, France also is working on developing a responsible investment label for private equity. So we'll see the outcome of this label, and hopefully it would help
Okay.
facilitate the conversation.
I want to get one more question in before the close, so thank you for that. But I've liked all the questions, but this one, I think this is a really interesting question in that we can learn from successes, but we can also learn from our missteps and our mistakes. So this question, what is the biggest mistake that investor reporters are doing today, and as they try to adapt to these new realities and evolving markets? So what's been a mistake or two that you've seen out there that has been a learning opportunity? And I'll start at the end, and if you don't have an answer, that's fine, but let's make it snappy, and we'll respect people's time. Nadia.
I think I need time to think about it.
All right, Leilani.
I don't need time to think. One of the biggest things is I think we get very caught up as investors about the information needs to be right, because we like accuracy. And having been in and around greenhouse gas emissions reporting for most of my career, I can guarantee you the number will always not be right. It'll be near right, but and auditors will come to realise this, but just get the data and get started, and don't let perfection get in the way of just good.
Okay. Sorry, I didn't mean to
No, that
be-
was fine. And look, I totally agree with that. And if I can just add one thing to that, which I think is a confirmation, is there is a different treatment sometimes of financial accounting and the sustainability data. We use estimations in financial accounting all the time. There's fear of that in sustainability. I think there is times where that is not the right solution, but there are times that it is. And I think that element of not trying to beat the perfect for the enemy of the good, I think is a confirmation of that.
Well, you're talking to somebody who sits on the International
I know.
Sustainability Board with a sister board called the International Accounting Standards Board, so I'm well aware of the tensions in those conversations, and they're good. And I'm going to say thank you, and thank you for your participation, and apologies if I missed any hands up out there, but we're going to wrap this up. And so I really appreciate the time and willingness on your behalf to share perspectives. I really appreciate the participation that you've had here. I hope that we've provided some sense and some solutions, some ideas of the things that you can do as asset owners, investment managers, or if you're a client on that side, some of the expectations you can have. But I wish you, we all wish you a good rest of the conference. I think there's a session survey, which is just a couple of questions. Please fill that out if you have the time. But again, have a good rest of the conference, a good rest of the day. Thank you.